I'm not entirely surprised. It almost seems like it would be too easy for all of these big companies just to file for the ETFs on the spot market and just get right through. Here was that news hitting the market again. We were up right against that resistance at 31,000 on the intraday. We flushed down to support. And then we've kind of just trailed off in this lower area here. And the other thing that I thought was interesting too is that today was the day that altcoins were starting to pump. And it was amazing how that just took a lot of the wind out of the sails of the altcoins.
Popular technical analyst and chief market strategist at InTheMoneyStocks.com and VerifiedInvesting.com, Gareth Soloway has reacted to news of the SEC rejection of BlackRock's and Fidelity's Bitcoin spot ETF applications. On Friday, June 30th, the Wall Street Journal reported that spot Bitcoin ETF applications filed by large asset management firms including Fidelity, BlackRock, VanEck, and Invesco were likely to be rejected due to inadequate clarity about a surveillance trading agreement, SSA, with a spot trading Bitcoin platform. According to the WSJ report, the applications did not identify a specific Bitcoin exchange that would engage in a surveillance sharing agreement with Nasdaq and CBOE, the exchanges on which the products will be listed if they are later approved by the financial regulator. The report further states that the SEC is very concerned about an SSA, which is designed to prevent fraud and market manipulation to ensure integrity in the underlying market of the ETF by being on the lookout for manipulative trading activities. Though the news came as a shock to the market, with Bitcoin's price declining by over 4%, sources familiar with the issue say it is not an indication that the product is not viable. In fact, many people believe the speed with which the SEC responded to the applications and the fact that they pointed out what was wrong with the applications instead of flat-out rejecting them as they've done in the past is a good sign that we are finally about to get a spot Bitcoin ETF. Both Fidelity and BlackRock are partnering with Coinbase for the SSA function, a fact that they omitted from their initial applications most likely because of the SEC lawsuit against the crypto exchange. Both firms have resubmitted their applications, this time mentioning Coinbase by name, and everyone awaits the SEC next decision. During a recent interview with Greg Dickerson, Soloway gives his outlook on the SEC preliminary rejection of the applications, the impact of the news on the crypto markets, and what an approved spot Bitcoin ETF would mean for the entire cryptocurrency industry. Before we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos. Also, ensure you drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I'm not entirely surprised. It almost seems like it would be too easy for all of these big companies just to file for the ETFs on the spot market and just get right through. So I think the biggest takeaway is initially we saw Bitcoin fall sharply, right? It went from around 31,000 back to 29.5, but it's kind of come back to settle in that $30,000 range. And I think what we take away from this is that it's not horrible news. It's not great news, but it's not horrible. I think the term used was inadequate. Right. So that doesn't mean they're not shutting it down. They're saying we need more information, or we need you to do more due diligence, or give us whatever we need. And then it seems like they're open at least to it getting through. But I think also, from what I know, with at least the legalities between the SEC and Coinbase, they're filing not with Bitcoin specifically, it's with other things. So it's with the altcoins, right? The ones that they're claiming are securities. So maybe that also leaves a small door open. I think, honestly, I always look at price action, and price action has been pretty muted, right? You had the initial reaction, and let me show my chart here, but we had the initial reaction, and let me go to the intraday 10-minute chart. Here was that news hitting the market. Again, we were up right against that resistance at 31,000 on the intraday. We flushed down to support, and then we've kind of just trailed off in this lower area here. If we go to the daily chart and you look at Cardano, for instance, Cardano was up into resistance earlier today, looking like it was trying to break out and go to this next level of 33, 34 cents. And that news just slammed it right down. So by hitting back at Bitcoin and the ETFs, they kind of took out the wind from behind the sails of the altcoins as well. Ultimately, longer term, there's no doubt that having spot ETFs that are brought to the market by Fidelity or by BlackRock, that's a positive. That's a net positive. But you're right. We're talking about a year to a year and a half away. the crypto market barely can focus on a week to 2 weeks away. And so how do you, when you talk to crypto investors, when this is so far away, do they stick around? What if, and again, this is my bear case, right, for Bitcoin. If Bitcoin is going to revisit its lows, it's not going to, in my opinion, have to do with a new fraud, a new this or new that. Even with Binance, the markets has kind of digested the chance that what the SEC has claimed is true. But the bigger question is, if you look at what's going on with the stock market and just the relentless upside action we've been seeing in certain stocks, let's say we do all of a sudden get a corrective move in stocks of 10, 20, 30%. How does that then affect Bitcoin and the crypto markets if you see a run for safety? Because I don't think at this point yet we have Bitcoin is certainly not a safe haven yet. All right. We saw a little bit glimpse of that during the banking crisis earlier this year, but it's really still been trading as a risk asset.
Let's assume we do get an approval and then the market tanks. Do you think Bitcoin can hold up at that point?
And to me, that's where I personally don't think so, because again, if there's one thing, the COVID tank, and again, that was a black swan event. It caught everyone off guard. But one of the things that I remember vividly from that period, as well as past really panicky sell periods, is that even gold sells off for short amounts of time. And so I think people have to realize that even if you get to be that panicked market, that everything is going to dump. It's people just freak out and they just dump all asset prices, even if it's something like gold, which is a safe haven, at least in the short run. So that kind of opens the door for maybe a buying opportunity if that happens, even if a spot ETF has been approved at that point. And let's not forget that the top on the last cycle was exactly when the futures ETF got approved. So here we see that certainly it wasn't like all of a sudden that was the new bull market. That was actually the top of the bull market when that happened.
According to Gareth Soloway, there are lots of macro headwinds ahead for the United States economy in this second half of 2023 and beyond. All of these headwinds, especially the possibility of a moderate to severe recession, would negatively impact the stock market, cryptocurrencies, and the entire economy. Even with the approval of a spot Bitcoin ETF, which undoubtedly will be a bullish event for Bitcoin and other cryptocurrencies, Soloway is convinced that Bitcoin could still drop lower when these macro headwinds begin to fully reveal themselves. However, the technical analyst views all price declines as an opportunity for stackers and investors to buy even more Bitcoin and other cryptocurrencies for incredible long-term gains. Let's get back to the discussion as Soloway discusses his outlook on what's to come for the markets and the entire economy in the coming months.
There's some things that I'm seeing in these charts. And so this is the 10-year yield chart. And what we had was a wedge pattern that was a bullish wedge pattern. We broke out yesterday with that solid economic news that we got, the GDP revision to 2%. And then today we had the slightly better than expected PCE number, which kind of brought back in from this next resistance level, which is what to be expected, right? We broke out of the first one, but the second one hasn't been tested yet. It has to pull back. But this is the key, is that are we going to see a bigger breakout on yields if this channel, see this beautiful, this is actually a bull channel. In fact, it's very, very similar to what we've seen on gold play out over the last 4 years or so, the same pattern formation. And if this starts to break above this line, you at least are headed back to 410 and then maybe the highs of 436 on the 10-year. And the question is, the higher rates go, what do risk assets do? That's the question I have. And I think also what's concerning to me is the divergences that we're starting to see. So if you look historically at the 2-year versus the stock market, or the 10-year versus, there's a very clear kind of coordination between what goes on there as well as the markets. And we've seen a divergence over the last, so long, let's say the last 6 months in the market with these signals. So something weird is going on here, something that is unsustainable if you look historically at the markets and at these other signals. By the way, another signal that I pointed out recently was M2 money supply. So M2 follows like every up and down in M2. Well, there's actually honestly been no downs until recently in M2, but you can see the vertical nature of M2 as it climbs. And in fact, let me see if I can bring this up here so we can all kind of take a look. But as M2 climbs, the market has always climbed. And let me go to the S&P 500. And then let's bring up the M2 money supply here. Let me break this up here. Let me see if I can follow. There we go.
Yep.
So what we can see here is if we go, and I can zoom, and I want to zoom out for everyone to see this, is that if you coordinate this with COVID, there's COVID and there's your money supply increase. And then look at the run as money supply goes up. Then look as money supply flattens and starts to decline. We have this. The problem is that this action here is down money supply while we have been rallying. And that, again, is problematic. That tells me there's something brewing here in the markets. And it may not play out for the next 6 months. We don't know. But at some point, there has to be a revision back in the markets or in money supply to some central point. So you can see this little bit of an uptick here in 2008 and 9, where money supply started to pop. And then we got this follow through in the markets where all of a sudden the markets popped. And then you can even see the matchup over here where another little blip up in 2011. And then that leads us, after this collapse down, into the next bull run in the markets. At least from my perspective, the divergence can't last forever. At some point, the markets have to come back in. But I do think that there was so much money on the sidelines because investors were so worried about a hard landing, and now everyone feels like they missed the boat, that they're all chasing, and that's creating this divergence where people are saying, hey, listen, we're going to have this beautiful soft landing, everything's going to come up roses, and so they're willing to kind of chase stock prices up at these levels. And I'll show you another thing that definitely is a bigger and bigger concern of mine. Ignoring the trend lines, but just looking at the yields. All right, you now have the 10-year a full 1% plus lower than the 2-year. And that, again, I mean, historically, that's something that has to raise alarm bells from investors. That, again, that if you look historically, that signals something down the road. But I agree with you. I think there's probably enough liquidity in the market to keep us from anything major until the end of the fourth quarter. But I do think we're due. I mean, either way, markets have gone parabolic. VIX is so low now that no one is expecting any issues. And that's usually when we see some issue. And by the way, last weekend, we almost saw something, right, that the market wasn't expecting, which was the attempted coup in Russia. But by the time the markets reopened, everything was all good again.
Back to the spot ETF applications, Fidelity, BlackRock, WisdomTree, VanEck, and Invesco have all submitted revised filings of their spot Bitcoin ETF applications, according to reports. The refilled application, currently listed on the CBOE Global Markets page for pending rule changes, all explicitly named Coinbase as the exchange to enter into a surveillance sharing agreement with. Some sources say applications could also include other reputable exchanges, including EDX Markets, a recently launched institutionally focused brokerage backed by Fidelity and Charles Schwab. It is expected that the SEC will re-examine the applications and either accept them or return, with more questions about the applications. But many people, including several prominent figures in the cryptocurrency industry, are positive that at least one of these applications will get the SEC's approval. What are your thoughts on Gareth Soloway's interview and the SEC decision regarding the spot Bitcoin ETF applications? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more crypto-related videos and in-depth analyses from some of the industry's brightest minds. Thanks for watching.